Hi everyone. Welcome back. Please do not forget to like and subscribe. It may just be a click for you, but it means a great deal to me. Things you should know before investing in mutual funds. 1. What are your investment goals? Are you saving for retirement, a down payment on a house, or something else? 2. Your risk tolerance. How much risk are you comfortable with? Mutual funds can be a relatively safe investment, but there is always some risk involved. For example, 1. A young investor who is saving for retirement may be willing to take on more risk. They may choose to invest in a mutual fund that invests in stocks, which have the potential for higher returns but also carry more risk. 2. An older investor who is nearing retirement may be more risk-averse. They may choose to invest in a mutual fund that invests in bonds, which have lower returns but also carry less risk. It is important to remember that risk tolerance is a personal decision. There is no right or wrong answer, and what is right for one person may not be right for another. It is important to consider your individual circumstances and goals when making a decision about how much risk you are comfortable with. Here are some questions you can ask yourself to help determine your risk tolerance. 1. How much money can I afford to lose? 2. How much risk am I willing to take on in order to achieve my financial goals? Once you have a better understanding of your risk tolerance, you can start to look for mutual funds that are a good fit. There are many different types of mutual funds available, so it is important to do your research and find funds that align with your investment goals and risk tolerance. 3. Your time horizon. When do you need to access your money? Mutual funds are a good long-term investment. 4. Fund objectives. What are the fund's goals? Are you looking for a fund that will provide income, capital appreciation, or both? Income funds are mutual funds that invest in assets that generate income, such as bonds and preferred stocks. These funds typically pay out dividends or interest payments to shareholders on a regular basis. Income funds are a good option for investors who are looking for a steady stream of income. Capital appreciation funds are mutual funds that invest in assets that are expected to increase in value over time, such as stocks. These funds typically do not pay out dividends or interest payments, but they offer the potential for higher returns. Capital appreciation funds are a good option for investors who are looking to grow their wealth over time. 5. Fund expenses. Mutual funds charge fees, which can eat into your returns. Make sure to compare the fees of different funds before you invest. 6. Fund performance. How has the fund performed in the past? Past performance is not a guarantee of future results, but it can give you an idea of what to expect. 7. Fund size. Mutual funds come in all sizes. Larger funds may have more liquidity, but they may also be more expensive. Smaller funds may be less expensive, but they may also be more illiquid. 8. Fund load. Some mutual funds charge a load, which is a fee that you pay when you buy or sell the fund. No load funds do not charge a load. 9. Fund style. What is the fund's investment style? Is it a growth fund, a value fund, or a blend fund? Growth funds invest in companies that are expected to grow their earnings at a faster rate than the market average. These funds typically have higher risk than other types of funds, but they also have the potential for higher returns. 2. Value funds invest in companies that are trading at a price that is below their intrinsic value. These funds typically have lower risk than growth funds, but they also have the potential for lower returns. 3. Blend funds invest in a mix of growth and value stocks. These funds typically have lower risk than growth funds and higher risk than value funds. 10. Fund diversification. How diversified is the fund? A diversified fund will invest in a variety of assets, which can help to reduce your risk. Here is an example of how diversification can help to reduce risk. Imagine you invest all of your money in a single stock. If the stock price goes down, you will lose all of your money. However, if you invest your money in a diversified fund that invests in a variety of stocks, you will be less likely to lose all of your money if one stock price goes down. This is because the other stocks in the fund may go up in value, offsetting the loss from the stock that went down. Fund liquidity. Liquidity refers to how easily you can sell your shares. A liquid fund will be easy to sell, while an illiquid fund may be difficult to sell. Fund tax efficiency. Tax efficiency refers to how much tax you will pay on your investment gains. A tax-efficient fund will minimize your tax liability. Once you have considered these factors, you can decide whether or not to invest in a particular mutual fund. Is investing in mutual funds halal? Not all funds are halal, however. In Muslim countries, some or all mutual funds comply with Islamic law, which prohibits the investment of money in businesses that are considered to be haram or forbidden. This includes businesses that deal in alcohol, gambling, interest of any kind, or pork products. Mutual funds that comply with Islamic law are known as Islamic mutual funds. Here are some of the things that are checked in Muslim countries to see if a mutual fund complies with Islamic law. The fund's investments must be in businesses that are considered to be halal or permissible. The fund's management must be Sharia compliant. In conclusion, mutual funds can be a good way to invest your money. They offer diversification, professional management, and low cost. However, there are some risks associated with investing in mutual funds, so it is important to do your research before you invest. Here are some additional tips for investing in mutual funds. Start by setting your investment goals. What are you saving for? Retirement? A down payment on a house? Once you know your goals, you can start to look for funds that are a good fit. 2. Consider your risk tolerance. How much risk are you comfortable with? Mutual funds can be a relatively safe investment, but there is always some risk involved. Do your research. Read fund prospectuses and compare fees before you invest. By following these tips, you can increase your chances of success when investing in mutual funds. I hope this video has been helpful. Thanks for watching. Please do not forget to like and subscribe. It may just be a click for you, but it means a great deal to me.